GDP growth in 2025 is forecasted around 3%. However, expectations are that this pace will slow down as the year goes on.
And whilst positive growth is a good thing, 3% growth from your investments will struggle to keep you ahead of inflation.
So if you're looking for companies with a bit of extra sizzle when it comes to growth, then this is a video you'll want to watch.
We're asking 10 fund managers to nominate the stock they believe has the highest growth potential in 2025.
What's a company that you think can deliver impressive growth in 2025?
Yeah, so one within our portfolio that we really think has a lot of upside into 2025 is a company called Cyclopharm. So this is a nuclear medicine business, does functional lung imaging, and its Technogas product is already the standard of care for pulmonary embolism across many markets. It's taken the place of traditional CT scans. However, as always with anything in healthcare, the real pot of gold at the end of the rainbow, it's always the United States. That's where you can make the most money. And to that end, recently Cyclopharm was awarded pass-through designation by the FDA. I won't bore you with all the details, but effectively what that means is not only is this a clinically superior method of imaging lungs, but it's crucially economically superior for hospitals. And as a result of that, Veterans Affairs, which is the largest hospital owner in the world, nearly 200 sites, has recently signed an agreement to roll out the Technogas product across their sites. Gives Cyclopharm a real leg up in progressing towards their target for 2025 of 300 installations. We think there's tremendous upside in the stock if it even looks like they're getting anywhere close to that. We do think that eventually Technogas will dominate the market for functional lung imaging, and that implies annual recurring revenues well in excess of the company's current market cap.
So Zip would be my pick for growth in 2025.
Off the back of a big year.
I know, it's done incredibly well already, but I think they're just getting started. And I think one way to look at it is how the business has pivoted over the last 12 to 18 months. They've had a new CEO who's come in, Cynthia Scott. She's done an amazing job at refocusing the business and exiting non-profitable parts and growing, in their core markets. So now as they refocus into, partnerships, marketing, they should put themselves in a really good position to, grow customers. And it's really interesting. They've had an amazing growth year, but they haven't grown customers over this time. So I think that's still yet to come through.
So it's just a bit of a re-rate coming through.
Yeah, exactly. Yeah. Nice. And we still see the outlook for the US consumers being pretty strong, and buy now, pay later penetration is still only 2% of the market. So there's a long runway of adoption left to go.
So a company for us is actually a company called Sartorius in Germany. They are about a $15 billion market cap, so a little bit smaller than some others. This is a company that's really been doing it tough for the past couple of years. So they are the absolute sweet spot of one of the most durable themes in healthcare. It's biologics and biopharma. So old school medicines, we were fusing chemical compounds to make drugs like penicillin. New innovations now in bioprocessing, culturing live organisms and cells, allows us to be much more targeted in how we actually treat really hard to cure diseases. So Sartorius is one of the only pure plays you can access that's actually selling the tools to test for the R&D, the innovation, and to grow a lot of these drugs that are really going to help with things like cancers and gene therapy, etc. Has been a tough spot because there was an over-ordering by their clients during COVID, a lot of the vaccine development, etc. And we think we're right on the cusp now of those customers coming back to traditional ordering dynamics in 2025.
So one area that we're particularly excited about is, of course, the AI revolution that's going on at the moment. What's interesting, though, is in the ASX, there's not that many ways to play this thematic. So you see great companies like NextDC and the soon-to-be listed DigiCo Infrastructure REIT, they command very premium multiples. So NextDC trades at 50 times EBITDA, DigiCo REIT's going to list at 44 times FY25 EBITDA. So there's a US listed small cap stock that we're very excited about. It's got a $4.5 billion market cap at the moment. It's called Core Scientific. The ticker is CORZ. And it is leveraged to this digital infrastructure thematic and these enormous AI tailwinds that are going to play through the next, decade plus. And one of the reasons why we really like it is it's had the most amazing turnaround that I've actually ever seen in my investing career. It has 1.3 gigawatts of contracted power, and it has taken 900 megawatts of that, and it has basically changed that from Bitcoin mining to pursuing this AI data center opportunity. And over the past 6 months, it's signed a series of agreements with CoreWeave, which is the largest GPU as a service company in the world. It's backed by NVIDIA. It's likely to go public next year. It's currently got a $23 billion valuation. And this is the marquee customer for CORZ Scientific for their data center operations. They've signed a 12-year agreement which involves $9 billion US of revenue accruing to CORZ Scientific at 75 to 80% profit margins over that period. So it's a truly exceptional deal. This will see them generate in Aussie dollar terms over $1 billion of revenue and over $850 million of profit per annum from this one marquee deal. So we think it's significantly undervalued at the moment. And just to put it into context, that 500 megawatt deal it signed with CoreWeave, that compares to NextDC's contracted capacity of 173 megawatts and DigiCo REIT's capacity of 67 megawatts. So it's multiple times the scale, multiple times the revenue and profit, but a fraction of the multiple as it stands today.
One of the ones that I think of the preferences that I've had is Life 360. It's obviously pulled back recently, and I think a common error that everyone makes is it's more than just an iPhone tracker. It is also an ecosystem of services, continually broadening out that as well with the likes of advertising, tracking your pets, your objects with the tile integration. So for me, that is a key opportunity and one that I think will keep on continuing to grow throughout the year.
So I've got a bit of an unusual one. Like, there's been a lot of attention on Sigma in the last 12 months. I think it's up yesterday, 174% year to date, and that's largely on the backdoor listing of Chemist Warehouse, which has had a lot of attention. The ACCC's now given that's blessing, so that's going ahead. But realistically, that stock's probably going to be an ASX 100 stock, in the not too distant future. So for small cap investors, if you haven't been on that trade in the last 6 or 9 months, you're looking for what's next, and that's largely what we do. So what we've found in the last sort of 6 months is a company by the name of Paragon Care. Now, Paragon Care has been listed for a number of years, but in June 2024, they merged with CH2. Very similar, not a backdoor listing per se, but CH2 is a much larger company than Paragon Care, to the point that they now have more than $3 billion worth of revenue as a result of that merger. What's interesting about CH2, it's a very similar business to what Sigma and EBOS were before Chemist Warehouse. They're big in wholesale pharmacy distribution. CH2 is also really big in hospital distribution. This 85-year-old business was bought out by management in 2015, a management buyout. 2 gentlemen, the chairman and CEO of the business at the time, they vended that into Paragon Care and are now the CEO and chairman of Paragon Care going forward. What you've got now is a large wholesale distributor. You've also got a manufacturer and you've got a supplier into the majority of the hospitals. What we like about it though, why we think it's really interesting, is you've got really strong structural growth markets like hospital and pharmacy and the like that are growing sort of mid-single to high single digits year in, year out as the ageing population kind of plays out. At the same time, you've got a nice merger of 2 businesses with a huge amount of synergies. They've identified 5 million for FY25 and another 12 in FY26. In addition to that, you've got huge alignment. The 3 guys, the founder of Paragon Care plus the 2 founders of CH2 own over 60% of the stock. So you've got some really good ingredients there that suggest that this business, once they deliver on the synergies and they can start to do some of the cross-selling opportunities, that these guys that have delivered some pretty impressive earnings at CH2 when it was a privately listed company, an unlisted company, I should say, to where it is today, we've got the confidence that that can continue.
For us, one of our favoured names in 25 is going to be Boss Energy. So they're a uranium miner. They're just ramping up their first mine in South Australia called Honeymoon Well. They will see their production go from around about 800,000 pounds this financial year. It'll double into the year after that and then go again another 800,000 pounds into FY27. So it's actually a tripling from this year into FY27 and we think that will drive huge growth for their earnings.
One we've owned in the fund for actually a number of years and that's TechnologyOne. So the ticker is TNE. For those who don't know, it's the leading software player in Australia. They do software for justice, education, departments, things of that nature. It's not cheap, unfortunately, on multiples today, but it has had very strong earnings growth and I think can have really strong earnings growth into next year. So they just released their full year result. Earnings grew 18% and that was ahead of their guidance of 12 to 16. And then coming into 2025 and actually beyond, there's a couple of things that are driving earnings. Firstly, they've got new customer wins in Australia, which is their core market. They've also got product upsells. So you think when you take on a technology, you might not take all of the modules, you might take 1 or 2. Then over time, as you become more familiar, you take on more software. And then thirdly, the UK opportunity. So today, the UK is less than 10% of their revenue. provides a significant runway for growth in the UK market. And finally, the SaaS Plus offering. So they're converting what was traditionally implementation fee into the subscription revenue, which should actually drive higher earnings and cash flows in the coming years. So the business has less than 5% market share today, which is small. So we think earnings can grow significantly in the next couple of years.
Stock that we hold in the portfolio at the moment that we think is a standout for 2025 is Qoria. It's the old family zone, ticker QOR. So Qoria is a provider. It's a software in cyber safety. It currently has about 24 million children that it protects each year, and it's got about 30,000 schools across Australia, the UK, the US and other regions. This is a business that has had challenges over the last couple of years. So basically the balance sheet got out of whack. It was burning a lot of money. Management's come in, it's right-sized the cost base. It's projected to be free cash flow positive into 2025, and we think the outlook looks really good there. So it's currently about 120 mil of ARR that the business has. That's expected to go to about 200 mil over the next 3 years, and the pipeline looks really good. So they've recently announced some good contract wins. There's new partnerships they're doing with the likes of SoftBank in Japan, and what we should see over that time is that incremental revenue, about half of that's expected to fall through to profitability. So you get some really good material operating leverage coming through the business.
We've owned Trip.com for a number of years, and we think that it's still got great growth potential in 2025 and probably further out as well. It's the leading online travel agent in China and owns 50% of the leading online travel agent in India. So the company is benefiting from growth in travel spend in those markets, and it's also taking market share. So we think that sets it up well for 2025.